Hello and welcome to this week's Ferrari Financial US Market News Summary. Well, the beginning of the week up until Friday was fairly calm for the markets, not much happening even though there was some rather poor economic news coming in. But that unfortunately changed on Friday, however, when General Electric, which is really a bellwether for the Dow Jones Industrial Index, reported poor earnings and in fact a 6% drop in profits. I think Wall Street took this particularly hard because normally General Electric is very dependable and nearly always meets expectations. And when you get such a decisive drop in profits from a bellwether stock such as General Electric, it bodes very badly really for other large names this reporting season. And this report really underscored the University of Michigan's Consumer Sentiment Index dropping badly again. We were down to 63.2 in April from a figure of 69.5 in March, and it's really showing about a 16-year low now in consumer confidence. So what we feared would happen has in fact started now, and that is that the troubles in the credit markets are now affecting the consumer badly and is starting to filter through into corporate profits. And as we said last week, consumer spending really accounts for about 70% of the US economy, so it's not a good sign. Let's take a look at our Nasdaq chart.
We're going to take a look at the one-year chart now for the Nasdaq Composite Index. We want to focus really on the events of the last few weeks where we've had this massive sell-off really since the beginning of the year. Really from just before Christmas we had this continual sell-off right the way down till the Nasdaq actually just above the 2,200 mark at 2,208 was the worst level before we had the pullback that we've had in the last week or so on the promise of a nice fiscal package with some tax cuts and of course the Federal Reserve stepping in with an interim interest rate cut followed by further cuts at their end of January meeting. And this very nicely pulled the market back up, as you can see here, coming back up to this line, this brown line, which is in fact the long-term 200 moving average. This is a long-term average line, and when you see that penetrated, that's always a bad sign. We're back up to it now, but we do feel that if we look at the trend line that's forming, possibly covering the peak and then across the pullback that we had just before Christmas, we're heading down at an angle of something like that. If that's the case, I'll just set that in so you can see it. There we go. Oh, and one more try. There it is. Now, if we see this pullback coming back up to about, at the most, about 2,500, then we're back up to where that trend line would intersect it around about here, and that's probably the danger point where this market could turn south again and continue what would be a much more prolonged downtrend. We do think this is probably the scenario going forward into the spring and early summer, because we do feel that we've seen the head and shoulders pattern fully developed here. The right shoulder, the left shoulder here, followed by the head pattern, and then the right shoulder forming just before Christmas. Now we've had the penetration of the long-term average line, and we do think that in a classic scenario we would see a little bit more of a pullback or consolidation over the next few weeks before then the market would probably turn southwards again.
So the Friday drop really underscored what was a bad opening week to earnings season, with such names as Alcoa, AMD, which is Advanced Micro Devices, UPS, and then obviously GE capping off the week with poor results, which was more than the market could stand, and the market sold off accordingly on Friday. Unfortunately, the bad results from corporations are liable to continue. In fact, it's difficult to see any industry groups, apart from possibly the energy sector and commodities, withstanding a poor reporting season for the first quarter. But even these stalwarts for the stock market, which have been really driving the market upwards in the last month or so, are liable to stall in the second quarter. So our take on the situation is that if the poor earnings reporting is widespread and worse than expected, with poor guidance going forward, you're liable to see the start of the second leg down to this bear market, which we've been anticipating really now for some weeks. It's difficult to see how the market can avoid this when you consider the number of bad issues on the table now, which have the potential to drive the market downwards. The poor earnings season unfolding, the continuing credit crunch situation spilling over into the consumer market, consumer confidence dropping like a stone at the moment, and why not when you consider that the number of mortgage foreclosures now is at a record high. And on top of all of this, you've got a deteriorating jobs situation in the US. Well, we'll be watching the earnings season unfolding very carefully, but until next week, it's goodbye from London.